Hi, welcome to the Interaxis YouTube channel, interaxis.io. Today we're going to talk a little bit about this concept of financial architects now, and the growth or the rise and the future of what we see as what we've kind of termed financial architects. Now, our thought and our idea of financial architects is kind of akin to investment managers, wealth managers, fund managers, whatever you want to call them. But now what we're seeing is taking this ability, this digital ability, this ability to add digital technology, digital assets, and protocols on top of each other, and create this ability for people to grow their wealth or grow their money, earn income, whatever it might be, on top of each other, and the ability of these financial architects, these people that might be a combination of finance minds, of programming, of the technical aspect, putting them together in a way that they can help manage my money. They can help give me the tools to manage my money or do it themselves better than the current products or the current investment products we have. So we're going to talk a little bit about financial architects and kind of what we think it means based on the current and future technology. So to do that, we have to take a step back, of course. We're in the traditional finance world as well. And in traditional finance, what you had a long time ago, of course, were the stockbrokers. And the stockbrokers would they try to get clients, and the whole point of the stockbroker was they would research certain companies and try to get you to actually buy those stocks or advise you on which stocks to buy. And there wasn't necessarily an idea of how it fits your overall portfolio. It was more of we feel like these companies will go up in value, the stocks will go up in value, or they kick off some sort of dividend which will pay you an income. And that was the idea of the stockbroker. They got paid a commission based on how much you spent, how much you bought, how much you invested. And that was the idea of the stockbroker. There wasn't as much of a putting together all of your finances into one. It was let's just try to get you to buy these certain stocks that they've researched. And move from there to the mutual fund or the fund manager, right, where these fund managers were actually looking at a whole bunch of different companies that might be in a particular industry or in a particular region. They had a kind of an investment policy statement that said, here's what we invest in. They did all this research, and you could then go invest your money. Instead of having your own account with your own stocks that you held, you went and just bought into the shares of this mutual fund. Most mutual funds are called open-ended, which means they're always issuing shares and they're always kind of redeeming shares every day, and their price, what's called their NAV, their net asset value, is based on the value of the equities or the bonds or whatever they hold at the end of the trading day. Right, so I can put my money into this fund, and they manage all the investments within this fund, and the value of this fund is based on the value of the investments divided by how many shares there are, and I own a certain number of shares, and therefore that's the value of my investment, and I'm offloading a lot of the management ability to a mutual fund. After that, we had like index funds. An index fund is basically a very, very, very inexpensive mutual fund, and all it does is essentially track an index like the S&P 500. And it can be very inexpensive because all it has to do at that point is own the exact stocks that are in the S&P 500 index in the exact weights that they're in the index, and it will track the index exactly, right? So you don't need to have a whole team of people to actually manage the fund. You're just doing whatever the S&P 500 does. And index funds took off because they were so inexpensive that you could have all this exposure to the S&P or the Dow or the Russell 2000 or what have you for a very low cost, much lower cost than the mutual fund, which has to pay these fund managers, these people that do the research, put all the stock, put all the equities or the bonds or whatever it is together, decide which ones they're going to do, file all the taxes, do all the administrative stuff. This is much easier. They took away a lot of the management needs, saying people are happy just investing in the actual index, in the S&P 500, and following what it does. And then you had ETFs, and ETFs are essentially, they can be kind of a combination mutual fund, index fund, but this trades on its own value. So you're not necessarily adding up the value of everything in a mutual fund and saying and dividing it by the number of shares and saying that's how much it's worth. An ETF is kind of like a stock in that it trades based on its own supply and demand. Within the ETF, they buy and sell certain equities or certain assets, but the ETF on its own has its own value based on its own supply and demand. So it can trade daily like a stock. I'm not buying shares like I am in a mutual fund. It's not an open-ended fund like that. So that's kind of where we are. Then what we have was the Robo Advisors, and the Robo Advisors. Actually, at the onset, financial advisors really didn't like the robos. We thought, okay, they're taking our business, because what they're able to do is the investor can go to Betterment or Wealthfront or Personal Capital or some of the other companies that offer robo advisors and say, I'm going to invest my money, here's my risk profile, and it would manage their portfolio, usually in and out of ETFs, which can be very low cost or no cost. It would manage their portfolio for a certain fee, and it was a lot less than they would have to pay an investment advisor, a wealth manager, where they might pay 1 to 1.5% to an investment advisor. They might pay 0.3% to a robo advisor that just says, look, we're going to put you in a 70-30 portfolio, which is 70% stock, 30% fixed income, and if this goes up to 75%, we're going to rebalance. So if this goes to 75-25, we're going to rebalance it back to 70-30. We're going to do this programmatically, and you don't have to touch it, you don't have to watch it, you don't have to pay someone to do it, because we can do this with computers, with algorithms, with code. So we moved on to robo advisors, and the cool thing about robo advisors is they got to where I can create a goal for myself if I want to. I can say, look, I'm going to put in $1,000 or $5,000 or whatever, and I want this to get to where I'm paying $1,250 or $1,300 for a vacation, or I'm putting in $5,000. I want to take my family on a vacation. I need to get it to $7,000 by 2 years from now, and I want the robo advisor to essentially manage it. They've instituted that level of kind of goals-based planning. So based on my risk profile and based on my when I need the funds to be available, it's going to manage it for me. So if it does really well early on, it can take a bunch of money off the table and store that in cash or some sort of fixed income products, and keep the growth aspect to get me to the value I need to get to. That's where robo advisors have gotten us, and there's obviously been a tremendous amount of interest in that by virtue of the fact that Betterment and Wealthfront and Personal Capital have built up all these users. Okay, so that's kind of where we are in the traditional finance world. I say all that to kind of roll back and go, okay, where have we gone in the crypto and the DeFi world especially? Okay, and that's where things have gotten kind of exciting. And that's where we see the idea of the financial architects, right? Because first, in crypto and DeFi, there was just this idea of trading, right? If you were going to make money in crypto and DeFi, it was just going to be trading, right? It was, first it might be buy and hold, right? I'm going to buy Bitcoin, I'm going to buy ETH, I'm going to choose some of these tokens I want to buy and just hold on to them for as long as I can or till they get to a certain value, right? Then there was trading. I'm going to go onto an exchange. I might follow some other traders if I want, or I might be able to do the charting myself, and I might trade some of these in a centralized or a decentralized exchange. And that's how I was going to make money. And there were actually some that tried to start kind of hedge funds or funds helping people manage or trade their accounts. And some people tried to do it online through crypto means and such. And it didn't actually work out all that well, because what we saw is, especially in the kind of crypto winters, when crypto fell, it all fell together, and a lot of those altcoins that people were trading just went to virtually nothing, and then you just had Bitcoin and ETH and a few of the other big ones that people were trying to trade. So enter now in DeFi, you have all these other opportunities for different ways to make money, different ways to make potentially income or growth or hedge or leverage or margin or what have you. and you have the ability to layer those on top of each other. So of course in DeFi, we call it the money Legos. The financial architects are the ones that are putting the money Legos together. And there are so many different ways that they're able to do this. It's astounding. So now what we're seeing is this has gone from, okay, so I might have this ability to use code to do this myself. Okay, so some of these financial architects might be creating the code that allows me to just say I want to go long. I have a certain risk profile. I want to go long crypto or long ETH, but I also want to earn some income. How can I do that? Well, maybe I can go long ETH and I can participate in some sort of liquidity pool, which allows me to gain some sort of income. All right. Or I might want to do some sort of like 50-50 balance of ETH and we'll call it Bitcoin. Well, I might be able to do that programmatically using some sort of code, some sort of architectural tool that has been built on top of these money Legos. It allows me to do this again, kind of like the Robo Advisors, without having to do anything, without having to monitor it all the time, without having to go into some sort of trading account and say, okay, I got to get back to my 50-50 split. Now what we've seen, and we'll talk about this in further videos, is you can even have it based on some sort of trading strategy. Like, again, ETH hits the 20-day moving average, and it's going to trade ETH for me, get in and out as ETH hits these certain technical points in the chart. Now, again, on top of that, now we layer other abilities to gain income, to grow, right? And so what this is going to cause is what we kind of see is this idea of mass customization. And the mass customization is going to mean I'm going to be able to put in some of my requirements and some of my characteristics, right? Here's my risk profile. Here's my goals. Here's the amount of money I'm willing to put in, and it can manage potentially all of my decentralized, obviously at this point, my DeFi denoted assets in a way that's going to fit my risk profile. So if I'm, moderate conservative or moderate aggressive risk profile, and I have certain goals, I want to be able to take my family on a vacation, I want to be able to, pay for my car, or whatever it might be, and here's how much I'm willing to put in, it can manage it all accordingly. And part of that can be in growth, which might be, again, like the long ETH. Part of it might be in income, which might be liquidity pools. It might be the new mining, liquidity mining. It might be some other aspects. It might be in lending. There might be some lending protocols that are paying relatively decent income. And it's going to rebalance all this to get me to my goal. So again, if I have a really good month, a really good week, or a really good day in terms of growth of some sort of one of these assets that I hold, whether it's ETH or Chainlink or Ren or whatever it might be, it might sell it, move that money into something that's fixed because we're taking it off the table, and let the rest of it be more at risk. And then if it has to pull that money back out of the more conservative asset and put it in the more aggressive asset, it can do that. Okay, so there are all sorts of abilities now to programmatically create this. And again, why we call these architects is they're going to have to understand the code behind it. They're going to understand how liquidity pools work and how some of the liquidity mining works, and understand the inner workings of synthetic assets, because we might now be able to build on top of this, not just crypto, but we might have synthetic, we'll call it S&P. We might have synthetic oil, synthetic real estate. Okay, that we're building on top of. Of course, we have to trust the oracles to come in and inform those values, but we might have synthetic assets that I want to build on top of and say, look, I want exposure to this. Or maybe we have to build in certain hedges, right? Because I might have, because by virtue of my job or where I live or whatever, I might have too much exposure to oil, and I have to hedge against this synthetic oil. Maybe I need a negative synthetic oil or something. I might want to have other hedges that take into account some of these other investments I'm in. I might need to have a hedge against ETH or a hedge against DAI or something. If I say, look, I want my goal to be I'm putting in 2,000 die, and my goal is 3,000, is to be at 3,000 die. But what if at some point the value of die relative to the dollar goes down, and I know I'm going to have to take that die, take it out, put it into dollars so I can spend my fiat currency? Well, at some point I might have to hedge the value of die. I might have to buy some options that guarantee that my die will be worth $1, and if not, then I'm going to be compensated for that somehow. The great part is we might even talk about eventually the tokenization of real world assets like real estate or hedge funds or whatever, and that can go into this financial architecture, and I can have this incredibly customized portfolio that's just for me. But there are these architects, or these people that are able to do it programmatically and say, look, Adam, we understand who you are, what you have. You're married, you have a child, you have to plan for college and retirement and your home and everything else, and we can build this whole system for you based on maybe some check boxes and a little bit of custom code that is basically going to manage your portfolio. So you can take out income at certain times of the year to pay for things, maybe like private school or college. You can have some more growth. You can actually put money in at certain times of the year, and we're going to be managing it all the time. The code is going to be managing it such that you get a certain level of growth and a certain level of income. Or they could just be really focused on, we do one thing really well. We find new tokens, or we really look at liquidity pools, and we find the best liquidity pools, and that's what we do really well. And so we kind of have a fund, and I used air quotes for fund because it might be that they've just created a token that I can buy that tracks some of these other tokens, or that tracks some of these liquidity pools, or actually invests in them, but all I have to pay for is the token. All right, and they're going to be looking at all these different incentive structures that are being created in the DeFi and the crypto world, and figuring out where can we find more income, where can we find more hedges, more options, more margin within the DeFi or the crypto world, and they're building on top of that. They're also able to find the data necessary. So maybe these financial architects are looking within Google or Twitter analytics or something and saying, okay, when we see something, when we see certain search terms that pick up in value, we know to go buy Bitcoin or sell Bitcoin or buy ETH or buy again, Chainlink or Tezos or something based on certain news, and they're able to architect that and do it all in a very programmatic way. So again, what we see is they're kind of a combination of potentially programmer, technical person, engineer, data engineer, and financial person that's able to understand all that and how to take the incentive structures, the systems, the tokens, the value that's been built, and find a way to extract as much value that fits me personally or fits their clientele very personally and in a very customized way. What we're seeing is the ability to do that more and more. What we see it is for instance, in real estate tokens in the future. We've hypothecated that there might be an ability to say buy real estate tokens that are that represent real estate, say in Dubai or in Texas or something that's very correlated to oil. The real estate is very correlated to the price of oil, but then also hedge against the price of oil. So if oil goes down, we still get some value there. That can be potentially created. So again, the financial architects that are learning right now and honing their craft and learning the technology and taking what they know from the tech and the programming and the engineering world and applying it to the financial world and saying we can build some of this, and they can be anywhere in the world because they're just designing systems. And of course there's also systems like Set Protocol and Melon and Zapper and stuff that are giving them the ability to actually build these funds and to kind of raise the money in a way that they can literally be anywhere in the world and raise money in a decentralized way, raise money via cryptocurrency by connecting my wallet, raise it potentially without the KYC AML needs. Is just tremendous and phenomenal. What we're going to see is so many of these financial architects kind of coming out of nowhere and building some unbelievable investment opportunities, and you might not even know who these people are. You won't see them necessarily on CNBC and on the covers of magazines and as these hedge fund titans or something, because they're just quietly amassing all this money that they're managing, and they're doing it from anywhere in the world, from a computer or two, and they're able to build these algorithms that allow me as an investor to create more wealth for myself and to create it in a very customized way. So that's why we're so excited about the idea of financial architects, these people that are taking their understanding of data and computers, programming, software, blockchain code, decentralized finance, couple it with some traditional finance, and build these unbelievable tools for this customization of wealth management, customization of growth of assets and of income, and customization of my ability to have my personal portfolio managed, my personal financial plan. And the financial planners that are coming are going to have to understand all of these tools to be able to fit them into a plan and see where they fit. Does my client need complete customization? Can we pick and choose some of these other these architected solutions for our clients and put them into their portfolio, and how do they fit? So that's what we want to talk about with financial architects. We're going to have several more talks, several more videos about some of the protocols that are being used and some of the avenues that are being explored. But we wanted to talk about financial architects, kind of what we are, what they are, or what we think they are. It's a term that I don't think has been used all that much, but we're starting to see that. We're starting to see that some of these people that are creating these funds are not necessarily the traditional investment fund people. They are coming from the more of the technology / finance world, the fintech world, and creating this financial architecture that is just going to explode in the next several years. So we hope you enjoy this. We hope you'll subscribe to the YouTube channel there. Check out our website, our courses, and our videos that are coming out. Check out some of our blogs and our podcasts with hopefully some of our very, very interesting guests in this space and in other spaces. And we hope to see you in the next video.